Hi, this is Steve from thegreshk.com. In this video, we will identify the different option Greeks together and examine their relevance in option pricing. Option Greeks are not part of an option price, but rather they give information about an option, such as its behavior towards price change, change in volatility, or change in interest rate. Let's look at delta. Delta is the amount an option price is expected to move based on the next $1 change in the underlying. This value is expressed between 0 to 1. Open an option chain and you will notice that calls have a positive delta, and for puts, delta is always negative. This would make sense if you think of it this way. All other factors remaining constant, the next $1 increase will make calls more expensive since it increases their moneyness, while making puts cheaper since puts move further away from the money. The opposite happens when the underlying price moves down. A delta of 0 means no sensitivity to the next $1 change. This often connotes that they are so far out of the money they are most probably not going to end up in the money. A delta of 1 or negative 1 means that the option is very deep in the money, that it is most probable to end up in the money, and that it is so deep that the option reacts on a 1:1 basis for every dollar change of the underlying. Options that are exactly at the money have a 0.5 or negative 0.5 delta. Being short delta means having a delta with a negative number. When you buy puts or sell calls, you have a negative delta. Being long delta happens when you short puts or buy calls. Delta is not a constant figure. Delta for a given strike changes as the price of the underlying changes. As you approach expiry, you will also notice delta being more and more concentrated to the options in the money and near the money. As options go deeper into the money, they will have a higher delta. And after knowing what delta is and how delta works, you'll understand why delta is used interchangeably with probability of in the moneyness by option traders. What does delta tell us in this option chain? Let's examine the delta columns for both the calls and the puts. Price-wise, for every $1 change in price, you experience the corresponding delta amount increase or decrease in your option price. An increase in the call price would increase the price of your call, while for the put, it's the opposite and vice versa. You will also see that options very deep in the money have a value near negative 1 or almost 1. And since IE is currently trading at 176.65, there is no perfectly at the money option, but you will see that the option with the 175 strike has a delta of near 0.5 and near negative 0.5. The delta effect is reflected if you're an option holder. This means when you sell calls or puts, the delta effect has a reverse effect. Shorting calls or longing puts are negative delta positions, while longing calls and shorting puts are positive delta positions. Lastly, the positions expire in 37 days. Options in the money beyond the 1 ST level, that's beyond 190 for puts and below 165 for calls, are very deep in the money and are very reactive to the next $1 increase or decrease in IE stock price. The following is a chart where we plotted the delta values of the call options on the option chain you saw on the previous slide. As you can notice, delta develops in a nonlinear slope, increasing or decreasing in lesser amounts as it goes further away from the current base price. Same can be said of the delta factor of i.e. put options. You can see that delta development is not linear, but more of a slope. The values are just the other way around, but how delta works and behaves remain the same. Let's look at gamma. Gamma is the rate of change in delta for the next $1 move. The graph you see is the plotting of the gamma values of i.e. option chains expiring in 9 and 37 days. We can observe that the options closest to being at the money have the highest gamma irregardless expiry, and that nearing expiration gamma factor increases. You can see both of these characteristics on the chart. The options expiring in 9 days, evidenced by the blue line, have more than double than the options around at the money, expiring in 37 days, shown through the red line. The price of IE on the option change screenshot was at 176.65. Options with a strike closest to this value, as you can see, have the highest gamma. Now let's talk about the option Greek Vega. Vega refers not to historical or actual volatility, but the implied volatility or the volatility risk. Vega shows the sensitivity of an option price to the change in implied volatility. It's the amount of monetary value that an option will change per percentage change in implied volatility. Options at the money are most sensitive to changes in volatility and thus show the highest Vega figure. And if you were to plot Vega, Vega behaves similarly to gamma when it comes closer to expiration and if it is close around at the money. Take a look at the Vega and gamma columns of IE options expiring both in 37 and 9 days to confirm what you've just learned. Moving on to theta. Theta is a time value component of an option. Options are expiring assets. We've learned that options are great instruments for hedging and leveraging, but we've also learned that options are only valid for a certain period of time. Time decay is exponential as it nears expiry, especially for options that are close at the money. Being long put or long call decreases the value of the option or the value to be received for the option. You can see this in the following slide as theta is presented as a negative figure. Of course, if you're short, this would be positive. This is what you earn per day as an option seller, all other factors being constant. Time decay makes options cheaper over time. Here is the same snapshot of IE's option chain for you to confirm what you've learned. The theta number on the picture represents the amount you lose per day as a buyer of a particular option contract. Sellers earn this assuming all other factors remain constant. Let's take a look at rho. Rho measures an option sensitivity to a change in the risk-free interest rate. This Greek tells you how much option price changes relative to a 1% increase in the risk-free interest rate. If you're buying or selling options expiring in less than a quarter, this is not really relevant. It only becomes relevant when you start trading long-term option strategies.